I'm just going to spend today's. I'm actually doing two talks here as the way things worked out. Tomorrow I'm just going to focus on the companies I invited, and I'm just going to spend a couple minutes on each and explain, why I follow them, why I invited them. Today I'm going to just deal a little bit more with the market in general. November is not considered the best time of year in the market, especially in this sector. But the truth of the matter is, Scott and I very intentionally chose November as a date to have one of these, because this is actually the right time of year to be looking for stuff and to be shopping. If you're a buyer or a potential buyer, you want to be looking when things are cheap, not when they're expensive. So as frustrating as it can be as a shareholder on the positions you already own, with the way things tend to go this time of year with the trading, this is actually the right time of year to be looking. That doesn't mean you have to go buy something on Monday, but I'm just saying this is the right time of year to do your shopping and do some patient positioning. It's getting colder. It's been raining for the last 2 weeks. Perennial questions: is that gutter leaking? Who's going to rake those leaves? And of course, what the hell happened to all the juniors in my portfolio? I thought everything was trading at 30% higher prices last month. What the hell's going on here? Any of us that own this stuff, we've probably all got portfolios that look much the same, where suddenly you get in November, prices drop, bids get thin. It doesn't take a lot of selling for these things to get knocked down. It's very easy to get frustrated and want to walk away from all this stuff. But like I said, this is the right time of year to be looking. Now, there's a couple of ways you can deal with, tax loss season, and that's what that is. Basically, liquidity dries up. It seems like you get these losses every day when you've got people peeling things off and people that are maybe down already, they're selling into the bid. Usually, this time of year it's not a negative time of year for the gold price, but it's generally a weak one. I mean, normally on an average year, if you go back for the last 40, 50 years, then the average gains you see in the gold price in November, December are like maybe a third or a quarter of what you'd see in January, February, or August, September. So people just kind of get down on all of this stuff. Tax loss selling is the biggest one. So how do you deal with this? I mean, this is a perennial thing. It's something as a trader you got to get used to. I mean, there's a couple of ways you can deal with tax loss season. This is one. Simple, quick, effective, not recommended, particularly if you're a day trader, because you'd only be a one-day trader. But I would suggest a few other ways to deal with the situation. Okay, I'm just kidding. It was a joke. These trading patterns, they're never exactly the same. The truth of the matter is, if you look at a 10-year chart, and I didn't bother putting one in here, for say the venture exchange, you'd actually be hard-pressed to find that obvious pattern for the index as a whole, because there's so many different things that move the index around. There's commodity prices, there's the impact of the bigger markets. Tax loss is just one of them. You do see it much more obviously and clearly at an individual stock level, and that selling season is something that we just need to learn to deal with. There's usually 2 or 3 things that will be harbingers of that and will usually point you to stocks that are most likely to have that issue with a real tax loss selling pressure. And that's sort of what I'm going to go through, is what kind of stocks can you usually expect to see this with, and how do you deal with it. And like I said, it's not a bad thing if you're looking for good stories. It is absolutely not a coincidence that one of the MIFs is in early November. My partner, Scott Gibson, very purposely chose that date, because we're trying to find times when people that come here and listen to these stories get the best buying opportunities. So at the time when it feels like the crappiest time of the year if you're trading, and it feels like the crappiest time of year maybe if you're the CEO of one of these deals, that's actually the time you want to be shopping. So that's why we picked a November date for these. Where do you get the most of it? Normally, not surprisingly, since it is tax loss selling, normally if you've got a stock that had it's not generally so much the big spike, that can be a problem, but it's normally a stock that's had fair amount of stability at a significantly higher price, where the prices come down quite a bit, either because of seasonality, bad results, problem with commodities, price that the company is looking for. Sometimes it's just because a couple of earlier cheaper finances have come public, and those things become tradable. once you start one of those down moves this time of year, you do get a selling beget selling situation. And normally when you look at these things, it's very easy to sort of fall into the, December is going to be the bottom. Everything bottoms out 3 days before Christmas. The truth of the matter is it actually happens a lot earlier than that. And I've found that it's been happening earlier every year. If you think of what I call pro traders, and that would be brokers, people that make their living trading, people that CRA has decided make their living trading. The difference between them and your average person is they're not paying capital gains and losses, they're paying income, and in both directions. So they've got twice the rates going both ways. They tend to be much more definitive and assiduous about making sure that they've done their tax loss selling. I think you would find most brokers and pro traders, they start their tax loss selling in August. They don't start in December. Most of those guys, and that's part of my point, is most of those guys, and they certainly are usually a fair chunk of the tax loss selling volume every year. Almost without exception, those guys are done. They did it a month ago, 2 months ago. Because the thing with tax loss selling, it's one of those things where very much, if you're on the sell side, the early bird definitely gets the worm. You want to, if you want to be tax loss selling, you want to be doing it early. Ideally, you've done a lot of it already. You don't want to wait too long because as a seller, the market's going to be less and less favorable for you. But on the other hand, if you're a buyer, being the late guy tends to work out for you because usually companies with tax loss selling pressure tend to bottom out. These days, late November, early December, usually the bottom's right around the end of November most of the time. Occasionally you'll see one literally bottom out around the last day of tax loss selling, which I believe is Christmas Eve this year. But that's unusual, and most people do not wait that long, and you shouldn't if you're on the sell side. So, I mean, there's a couple of things you have to think about if you're in that situation. I mean, obviously, do you have gains to protect in the first place? Hopefully you do. If you don't, it's obviously not, unless you've got some reason to have just turned against the stock and you don't like the company anymore, there isn't necessarily a big hurry, and there's something to be said for waiting long enough, because stocks that have this kind of pressure do tend to get a bit of a bounce in January. So if you don't need the tax loss, it might make sense to wait until then and basically defer the loss and deal with it later. Alternatively, if you like the company, but you're concerned that there's going to be a lot of tax loss selling, you do have the alternative of being one of the earlier sellers during tax loss season. You have to be sure, if you do this, you have to sell all of it. You can't have any of the position left. You wait at least 30 days, you can buy back and still use that loss later. And then you can just reestablish the position a month later. But remember, if you do that, one, you have to sell all of it. If you leave 1,000 shares, you screw it up tax-wise. And two, you got to be out completely for a month, but only a month. So if you're doing the trading early, it can sometimes make a lot of sense to do that if you still like the stock. But whenever you're looking at your portfolio and making these decisions, I mean, you should always just ask yourself, company X, would I buy this stock today at this price? If the answer is really honestly no, it maybe shouldn't be a tax loss sale. It should maybe just be a sale, and that's it. Move on. It's hard sometimes, and I own a lot of stocks, and a lot of them I own because I like the story and I like the management. But it's easy to get married to these things. It's not the best idea, but it's easy to do when you really get familiar and really like a deal. But sometimes it's worth looking at your whole portfolio and saying, would I buy this stock at this price today with what I know now? If the answer is no, maybe you shouldn't own it anymore. How to use it to your advantage? I mean, I've gone through some of that already, but, there's two types of companies. I mean, some of these are tax loss selling pressure. The other thing I've seen this year, and this year's been a pretty extreme example, actually. This is one of the worst years I've seen for seasonality. And by that I mean traders selling on news that's good, bad, or indifferent simply because they think it's gotten to the end of the major news flow. I think any of you following stocks up in the Golden Triangle, you can probably think of two or three of them. I mean, a couple ones that come to mind, and I'm not dissing these guys. I'm just using them as obvious examples. Like you look at GT Gold, you look at a company like Aben. Both of those guys put out good results, but as soon as you get close to the end of the season, or in the case of Aben, I think the last set of drill results was the last ones of the season. It was a pretty good set of drill holes, but people just sold the crap out of it because they know where they're located. there won't be another drill release for 9 months. That's just how it is. That's the climate. There's nothing they can do about that. This year I have found it's pretty extreme. It's something to keep in mind too if you own positions of stuff up in that area that's still flying pretty high. Keep in mind, take a look at guys that have already finished their reporting. I mean, the seasonality effects have been very strong this year, so you might want to keep that in mind in terms of making sure you've taken a bit of money off the table before the last set of drill results comes out. But on the other side of it, tax loss selling is generally not an issue for companies that don't have a big seasonality issue, that are in fact going to be reporting. And a lot of the companies even up north are going to be reporting for another month or two, because this has been a bad year for lab delays. But if you're dealing with a company that's in that's in South America, it's in West Africa, it's in Australia, whatever, where they're going to be reporting for the next 3, 6, 9 months, or they don't even have that much of an off season, you don't generally see tax loss selling as an issue. I mean, people will sell when they don't like the stock anymore, but you don't get this seasonal pattern the way you do with northern. This is really more of a northern explorer thing when you're dealing with tax loss issues. The other thing to keep in mind is that, sellers, especially the early guys that sell, and they tend to be pro traders. Pro traders are the suppliers of a lot of the bids in the market. So when they've done their selling, they tend to be pretty stingy when it comes to putting new bids up, even if they want to reacquire it. So you will find that bids get fairly thin. So size positioning is pretty important if you're thinking about having to do tax loss selling. If you own a company that trades 30 or 40,000 shares a day, just on average, and you own a couple 100,000 shares of it, and you've decided you really need to trade it for tax loss purposes, do not wait until a week or 2 weeks before the end of tax loss season, because the bids will be terrible. If anything, the liquidity will get even thinner, and if you really need to sell it, you'll be forced to just hit bids all the way down, and you'll basically get a much crappier price than you need to. So, keep in mind how much you need to sell in relation to what the average daily volume is, and realize that going towards the end of tax loss season, the liquidity tends to be even worse. The bids definitely tend to be worse. Guys that want to own it, they know there's going to be the odd guy around that has to sell, so they'll just drop their bids down. And that's the other side of this when I say, how to use it to your advantage. If you're looking at things where you want to buy, you don't have to do a trade. You don't have to think about it, execute it, do it, and be done at the end of the same day. If you like Company X and it's trading at, say Company X has had a decent year, they had some good results, went up to $1, it's gone back to 50 cents, you can see things are really thinning out. You've got another month and a half until tax loss season is over. There's always going to be a few guys wait till the last minute. It might be worth your while rather than buying 50,000 shares on the offer. Maybe you say, okay, it's 50, I'm going to put in a stink bid at 40. I'll just tell the broker good until canceled, so that you don't even have to think about it. As long as you're happy paying that price for it, you just put in a stink bid, forget about it, and you get what you get. If you decide you desperately need to own it halfway through December, you can always buy offers, but use it to your advantage to get the best price you can during that period. Now, and obviously you just look at what you have to offset. If you don't have much to offset, like I said, you can always wait if you still like the story. There's no reason that it has to be this year's tax loss selling. You just you defer the losses, because you can only carry them forward so long. They're not eternal. So, how do you take advantage of this? And with this sort of last period, the last 2 months being the way it has been, is there a reason to be doing it? Is there anything to look forward to? And I'd say generally yes. A lot of people I've talked to in the last month have been pretty bummed out, because this time of year gets to people. But I think there's reasons to certainly some good reasons to be optimistic. I don't believe in throwing in the towel until the middle of January. That's what a lot of people do. But I'll say this: when these things tend to bottom out early, first, second week of December normally. If you're one of these guys that throws in the towel and I'm going to come back in the middle of January, you're probably paying 30% more than you have to for most of the stuff you're going to buy. Like, you want to be looking when nobody's paying attention and everybody hates the market. That's when you get deals. And I think, and again, keep in mind, there's plenty of companies, including a lot of the ones out there, a lot of the ones and the other guys I've invited to MIF, that don't really have seasonality issues. So this isn't really a factor for a lot of these guys. There's a lot of companies out there going to be reporting straight through. They're working in parts of the world where the seasonality and the tax law stuff really isn't an issue. Reasons to be positive? Yeah, there are some. Gold's had a crappy couple of months. But if you look at the chart on the right, you take a look at the bottom at the end of last year, you take a look at the bottom in July, you draw a line through those. The basic uptrend is still in play, yes, we're close to that uptrend line, but we're still in the uptrend. There's been a lot of volatility. It's gone high. People are quite concerned about the fact U.S. dollar strengthening. That's the chart on the left. Yeah, it's strengthened, but I mean, I'm surprised, frankly, at the amount of ink it gets in the financial press, because really, if you look at that chart on the left, yeah, the U.S. dollar's in a rally, but it's not what I call a super impressive rally, not yet. I mean, it's gotten itself off the ground, and there's a lot of reasons to think. I don't personally expect to see this huge rally in the dollar that a lot of other people do. Partially because I'm not as down on some of the other areas like the Eurozone and China. I don't see those currencies doing as badly as people think. I mean, I think people constantly underestimate the euro. I've been more bullish than most people on the euro for years, and I've usually been right about it most years. It does better than people expect it to. It just seems to be a knee-jerk thing, especially in Wall Street, to go, the euro is going to get killed. But I've been hearing that for 10 years now, and the euro is trading higher now than it was then, so I'm not that negative on it. The other thing, too, is a lot of what drives currencies is rate differentials. Now, if you look at these two charts here, the important one really is the one on the right. That's essentially that's the treasury yield there. And if you look at that one-year treasury yield, I mean, it's had a big move. I mean, and I'm not even talking going from the left side of the chart. You go from late 2016 to now, it's basically had about a 1% move. And part of what that's telling you is the short end of the bond market has already priced in all of the Fed rate increases, including the one that hasn't yet happened next month. The traders have already priced all of that in. I don't see, assuming that they do a rate increase next month, and I'm assuming they will. I mean, I'm not in the gold bug. They're not going to raise rates camp. I think they are going to raise rates next month. But the market has basically priced that in already, so I'm not expecting that to have a big impact. One other thing that's been kind of interesting, I mean, I've been sort of not really a believer, and I'm still not, honestly, in the whole inflation is about to come back story. But the chart on the left is interesting, because if you look at the oil prices against a 2-year inflation swap, and that's just a trade that traders use to basically voice an opinion on what they think inflation is going to be going forward, there's been a real divergence lately. The oil prices moved back up recently. You're not seeing these swaps move up. Traders in general don't believe in and are not pricing in the potential for future inflation. And you see that in New York, you see that in the States especially. Survey after survey after survey after survey, Americans simply don't believe inflation is coming back anymore. I mean, I'm a bit skeptical myself, to be honest, but the fact that the market is that negative on it, I mean, the surprises tend to be against consensus, so it may be that we get a bit of a surprise. And the reason that's important is that even a relatively small increase in inflation pulls down your real interest rates, and real interest rates are arguably the most important determinant of gold prices, and they're a very important determinant of all commodity prices. You want one of the best predictors of a gold bull market, you look for negative real interest rates, which basically just means inflation's going up faster than interest rates are, essentially. It's one of the best predictors. And so if we get a bit of an inflation boost, even though I don't personally expect one, it wouldn't take much of one with where rates are now for you to start seeing real interest rates really fall off, which would be good for the gold price. Plus, like I said, I don't expect a big move up in rates, in the actual market rates. I expect the Fed to raise rates next month, but I don't expect it to move the bond curve very much because it's already priced all of that in. So we may well get a situation very similar to a year ago where everybody was freaking out and the gold price got hammered going into the first interest rate increase in years. And as soon as the rate increase was done, gold started moving up because everybody had been selling the rumor and buying the news. And we may see that situation again. Similarly, there's lots of reason to be happy about base metals, and there happen to be a couple of base metal guys coming after me. Those are a couple of pretty nice one-year charts. I got to be honest with you, I was probably a bit more skeptical than most when it came to the copper price, because there was new production coming on stream. But for a lot of reasons in a lot of areas that I won't bother listing, there's been a lot of small problems that have added up to fairly large supply problems overall. They just haven't been growing the supply at the rate they expected to. And there's some potential big supply issues, like Grasberg, that they could really knock a couple of % off, which would be huge for the copper market. Zinc is just plain, zinc is in a great place. Supplies are not growing. Big mines that come off stream. We keep getting demand increases. I expect both of those, but particularly zinc. I'm expecting another leg up probably fairly soon. It's already done great. It's up to $1.50, but my expectation is we see a $2 zinc price in the next 6 to 9 months. It's not a coincidence. I've got the guys coming after me that I do. And the other thing that would help the gold price, it's not something I'm wishing for, because I don't think it's something any of us should really wish for intelligently, and that's the large markets, Wall Street getting whacked really hard. I'm not one of these, I'm not really a gold bug at all anyway, but I'm certainly not one of these apocalyptic gold bug, like, oh my God, we're all going to die types, like, boy, it would be great if Wall Street came off 90%. Well, no, not really. It wouldn't be great at all. But, is there potential for a pullback? I'd say yes. I mean, the thing that I find interesting, if you look at the top chart on the right side, and the top chart is really just an amalgamation of the two charts on the bottom. That's the investors' intelligence. They do these surveys like basically every week. Are you bullish? Are you bearish? Are you neutral? Right now, the bullish percentage is the highest it's been in 30 years. The last time it was this high was right before the market crash in '87. Does that mean we're going to get a crash? No. But what it does imply is that if everybody's that bullish, a lot of the buying power has probably been used up already. If everyone's that bullish, they're in the market already, which means there's just not a lot of dough on the sidelines. So it wouldn't take, to get like a correction, not a crash, I'm not hoping for that, but a correction wouldn't take a huge amount of bad news, just because I think so many people are all in already. The whole thing you hear on Wall Street about sideline money, I don't think there is a lot of sideline money. I think most of those guys are all in already. They're very bullish. So the more bullish they are, the more likely it is you're going to get a correction, just because the money's already in the market. There's no new fuel. So all in, I think those are all reasons that we can at least be somewhat positive, or at least not standing on ledges together. I think this is the right time of year to be looking for things, and I do think I think 2018 will be another decent year for us. And on that note, I'm going to introduce the first of 3 companies.